Good day. My name is Cor Kramekel. I'm an international tax partner with PwC, based in Johannesburg. With me today is my colleague Abelate Kahinde, a tax partner in our Nigerian practice. Today we'll be discussing doing business in Nigeria. Bo, for businesses who invest across borders, most of us know that every country has its unique challenges. There are many problems that you can avoid if you know what to focus on in the start. In Nigeria, what are the top 2 or 3 things that you suggest foreign investors must pay attention to?
Thanks, Cor. I think the first thing, investors should consider some of the same things that they would when entering any other territory. However, for Nigeria, it's vitally important that they go in with their eyes wide open. For instance, it's important to carry out robust due diligence before investing in Nigeria. This includes financial, legal, and tax due diligence. This identifies potential risks. However, it's probably most important to carry out commercial due diligence or a feasibility study to ensure the business is feasible in the first place. Secondly, investors should ensure their capital structure is absolutely correct. Broadly speaking, a foreign company doing business in Nigeria must form a Nigerian company. Therefore, it's important that the debt-equity ratio is carefully considered from a tax, profit repatriation and transfer pricing perspective. When finalizing capital structure, though, foreign investors should bear in mind the relatively generous incentives designed to encourage foreign investment. So, for instance, there's a foreign loan exemption, particularly between related parties. This can be structured to allow related party lenders to receive interest from Nigeria free from withholding tax. Finally, investors should consider carefully the effect of recent restrictions in obtaining foreign exchange. This is to pay for certain visible imports. This is having a negative effect on the economy, and investors are currently having to rethink about their supply arrangements to deal with this problem.
Thanks, Bo. What are the major challenges for established businesses who've already overcome the initial startup phase?
Okay, I suppose the first thing to note is Nigeria is a country that's still plagued by lack of power, poor infrastructure, and the lack of skilled labour. Therefore, investors should ensure additional cost of the logistical challenge of doing business is factored into their plans. However, an unanticipated cost could be the cost of complying with federal obligations, which includes companies' income tax, VAT, and withholding tax, but also in dealing with state tax obligations relating to personal income tax. For instance, a business with staff located in multiple jurisdictions in Nigeria could be facing, dealing with multiple state tax authorities at the same time. This means the length of time and cost of settling both state and federal tax audits could be quite considerable.
Turning our attention to the future, from a tax, legislation and administrative perspective, what are the major challenges on the horizon?
Yeah, I think it's a crucial time for the Nigerian economy, Cor. This is facing some real headwinds. The recent drop in oil prices has directly affected government revenue. Oil still represents 94% of Nigeria's exports and 70% of government's revenue, despite being only 11% of GDP. Therefore, the drop in revenue has triggered a real shift in the focus from oil to tax as a source of government revenue. Tax revenue as a proportion of GDP is now roughly about 2%, whereas in other jurisdictions the average is about 14 to 18%. This means that despite the high administrative burden, additional taxes and a shift in tax policy can be anticipated. For instance, the long-awaited VAT bill that's been shelved for many, many years could see a resurgence. The bill proposes an increase in VAT from 5 to 10%. Also, the much-debated petroleum industry bill includes an introduction of a hydrocarbon tax. This could see an increase in tax for gas producers of up to 25%. And we're also seeing a re-examination of the granting of certain tax incentives. This includes a review of pioneer status, which you might have heard of, and the generous relief from income tax for a period of 5 years. However, what's more likely to affect investors in the short term is the increased aggression that's going to be shown by federal and state tax authorities in collecting taxes, particularly from multinationals with Nigerian subsidiaries.
Lastly, Bo, there's a lot of talk about the OECD's current focus on BEPS. How do you see this affecting tax policy in Nigeria?
Okay, well, the Nigerian government's reaction to BEPS has largely mirrored that of other African countries. We've seen the introduction of transfer pricing rules that carry quite stringent compliance obligations in Nigeria. For instance, Nigerian companies and related parties are required to carry out localized transfer pricing analysis, regardless of whether they've formed part of a multinational group that has already developed a transfer pricing policy. And we've also seen the Nigerian authorities focus on the use of management and technical fees that are typically used to remunerate foreign related parties for services performed for Nigerian companies. There is an ongoing debate in Nigeria about the way in which such transactions are taxed and whether the income earned by the foreign companies should be considered Nigerian source income and taxed accordingly.
Thank you, Bo. Thank you for your insights in doing business in Nigeria. And thank you for joining us today. Hope you found it insightful.